Welcome to our part two session of year-end tax planning opportunities and essentials. Since we had so much content to cover in our first webinar, we've added a second webinar. So I'm joined by our two guest speakers, partners, Michael Gershon and Barry Sunshine. And I'll now hand it over to Barry to talk about year-end tax planning for individuals.
Thank you, Heather, and hope everybody has a great day and enjoying the day. Okay, so now we're getting close to the end of the year, and I'm repeated this a little bit from part one, but individuals and business owners of pass-through entities should be taking a look at what they can do to minimize their taxes because we work, one of the weird things about the tax laws is it starts if you're a calendar year taxpayer, it starts on January 1st and ends on December 31st. So there's a finite time frame to determine what your income and expenses are. So individuals, we covered businesses before, but individuals should be taking a look at what they can do between now and December 31st to minimize their taxes. There's some opportunities after December 31st, but they're much more restricted or limited. So let's just talk about some things companies can do or individuals can do to minimize their taxes. So if you are an executive or you're a wage earner and you get a W-2, all the compensation paid to you during the year is going to be taxed to you. Any money that you don't receive this year that you defer to future years, then you get taxed on it at that point in time. So let's say right around now, companies are determining their year-end bonuses to their employees, and they're figuring out which employees are going to get what bonuses. And if you're going to get a bonus, to the extent that you can defer the receipt of that bonus from this year to next year, you can actually possibly defer the taxes to next year. Now, the whole idea about tax planning is to try to figure out what your tax rate is this year and what is your tax rate next year. I mean, these are best guesses, and let's say you could even do long-term planning. If you can figure out your tax rates in 3 or 4 years from now, knowing tax rates will probably change. But if you can make a best guess what you think your tax rates are, you want to move your income into the lower tax bracket years because that reduces your taxes and that increases your take-home pay. Now, one of the things that we talked about earlier, and we'll talk about it again, is to the extent that you can defer taxes from this year to next year, and then next year you do it again to the next year, and you do it again and again and again. To the extent that you could defer income for 5 or 7 or 10 years, you get the use of the money in January versus December. You're deferring the taxes a year. But again, if you defer it for 5 or 7 years, you're deferring the taxes on it. It's in your pocket, the taxes. And long story short is those tax dollars could be invested, and that investments could generate additional income for you. So tax planning really makes sense. Now, if you're a self-employed individual, like a Schedule C, or whether you're a lawyer, a dentist, a doctor, or whatever type of consulting business that you're in, they're typically on the cash basis method of accounting. And the way to defer income is working out agreements with your clients and defer the income and the payment of it to you until next year, so you receive it in January. Another technique is send out maybe your December billings later on in December. That will ensure the receipt of the money next year versus this year. So some of those are the big plannings that you could do with moving income. The investment income, one of the things I'm saying to people is the market went down this year. So if you have securities under your cost, what you may want to do is harvest those losses and take those losses and harvest those losses. Now, some people don't like that idea of doing that because you can't go back into that security for 30 days because of the wash sale rules. But the reason why I like taking that, and even though it's limited to $3,000 a year, so if you have losses, capital losses in excess of gains, you can only offset your income by $3,000. So if you had a $10,000 capital losses, only 3,000 of it could be netted against your other income to offset your other income, and the balance, the 7,000, is carried over to next year. The reason why I'm a big fan of generating larger losses is next you don't. There's two different reasons. Next year you don't know what the market's going to do. So if it goes up, those losses will be used to offset future gains. But more so, mutual funds really distribute capital gains in right around December 31st, and they distribute the money even January 1st, 2nd, or 3rd, and it's deemed to be distributed on December 31st. So people who have large mutual fund holdings may find out that they have a large capital gains being distributed to you, taxed this year. So to the extent that you can use those capital losses against those capital gains, you're going to be better off on those.
Barry, what about a lot of our clients are invested in hedge funds and other types of alternative investments that it's hard to know during the year what the recognized gains are going to be. So that's another reason why harvesting those losses is a good idea, because you might not know what's coming through from some of those hedge funds.
That's right. Some of the investment partnerships may give out projections, and some of the projections are right on, some of them are not right on, and some of the hedge funds don't even provide the information because they don't think it's relevant to do it until they finish up the K1. So there's surprises on the horizon and so forth. So that's why it makes sense to harvest these losses. Now, the other thing is this crypto traders. I'm going to move up something that's a little bit below the line deductions, is the FTX losses. There's a fair amount of people that I've been talking to that experience these losses or these hypothetical losses on the FTX investments. Now, the IRS, right now, even though someone feels like they suffered a loss, if you had an account with $10,000 in there, you may feel that that account is lost because you don't have access to it right now. Under the IRS has issued, under the current tax law, the IRS has to come out and say it's a personal casualty loss and come up with a ruling on this effect. Otherwise, it's not deductible this year. So we need some favorable information on it. And I think it's too early for the IRS to come up with some of these rulings right now. Michael, are you seeing anybody with these FTX losses that are a little upset right now that they haven't gotten the losses, or I'm telling them they don't have losses just yet?
Well, it's hard to be the bearer of bad news. They are expecting at least to offset some of their income by being able to take these losses. And when we tell them what the law is and that we need to wait for guidance, it doesn't sit well with them. They've suffered a loss, but how we're going to be able to treat it for tax purposes is yet to be determined.
Right. So what I'm telling people right now, that's exactly right. What I'm telling investors in this FTX group, ignore the losses right now. Take other losses that you can harvest against other gains that you might have. And if once the IRS comes out with a ruling or some guidance on it, then we can figure out what we need to do. But you're not going to lose those losses that you have or that you've taken already. So these may be additional losses. So if you're a self-employed individual, I'm now jumping to deductions. If you're a self-employed individual, you're typically a Schedule C. So the deductions are, if you want to defer income, a way to defer income or taxable income is to increase your deductions, which has the effect of lowering your income. So to the extent that you can pay bills before the end of the year, that are deductible Schedule C or consulting, or if you're a lawyer or a dentist, if you could pay medical supplies and pay these medical costs, and that accelerates these deductions. So that really makes sense to do that. Another area is the itemized deductions. Okay, so certain itemized deductions like the SALT limitations that we talked about earlier, you can plan around it by making a PTET, pass-through entity election. Schedule Cs can't make that election, so you may want to have to figure out a way to best plan it going forward. Let's see, passive losses. If you have passive losses, which is real estate losses that you're not a real estate professional on, or you're just a passive investor in any pass-through business, and you're not involved in that business on a material basis, those losses are not going to be deductible. You don't lose them, you carry them over to next year. And if you dispose of that activity with those losses, you'd be able to take those losses at that point in time. So it makes business sense, but it doesn't make tax sense to generate it. But one of the things I see people doing is seeing that the classifications of passive investor income is properly categorized so they can offset these passive losses. So I'm seeing a mismatching of these investments that people are making and properly classifying to use these passive losses as opposed to just carrying them over later on. Michael, when you see an investor or an individual with a fair amount of K1s and, partnership share of income, K1s or subchapter S's, what are you looking for with these passive losses? What are you looking?
Well, it's interesting. A lot of our clients who are operate within the real estate industry are real estate professionals, and we want to make sure that all of the activities and all the K1s they're receiving are actual real estate activities. Sometimes it might be a management company. Sometimes it could be from a totally different type of business. So as you said, correctly so, you got to make sure you're categorizing them properly as either passive or non-passive activities. And if you have the passive activity losses, having passive activity income is a good thing because you can obviously eliminate that income from being taxed for that year.
Right. So let me ask you something. So I have a lot of clients that are real estate professionals. There's a lot of real estate professionals probably listening to this call, and we have a fair number of clients and friends that are real estate professionals. So what you want to do with the real estate professionals, because rental real estate losses are fully deductible and not subject to these passive loss rules. So you want to classify the rental real estate activities, right, in a proper bucket and make sure that the real estate professional meets the material participation standards of that. And I'll call it one of the things the IRS is harping on and what they're scrutinizing on audit is actually looking at diaries or some sort to prove that you're materially participating, because some clients think that they're real estate professionals, right? And in the tax returns, they just report the K1s, rental real estate losses. They didn't do the necessary grouping concept, and they don't have documentation showing that how much time they're spending on either one activity or multiple activities. Michael, what would you suggest to these real estate professionals to make sure that they do the proper documentation to protect those losses?
Well, I think there's two things. I think it's, if somebody has, switched accounting firms, I think it's important for them maybe to make the aggregation or a protective aggregation election again, just to make sure they're going to meet the material participation rules and be considered a real estate professional, because each activity without the aggregation rule would stand on itself, and it's hard to materially participate in each activity if you have 20, 30, 40 different properties.
And that's right. And what's really interesting, material participations, there's a whole bunch of standards, one of which is 500 or more hours in the activity. And the activity can include 20 or 30 properties, rental properties. Now, if in one property, if one activity or one K1 is developing real estate and the other 20 are rental real estates, you can't aggregate the developer with the rental real estate. It's only the rental real estate group that could be in the rental real estate professional activity. The real estate developer, K1, has to look at the material participation standards independently of that. So it gets really, really complicated and so forth. And what Michael correctly said is the aggregation rules are critically important because you want to make sure that that bucket is so. One of the benefit is the net investment income tax. Now, rental real estate professionals that show a net profit, we're avoiding the passive loss rules because if they have 30 properties in 30 different partnerships and they aggregated them, if they had, let's say, $100,000 of income, and if they meet the material participation rules, then they wouldn't be subject to the 3.8% net investment income tax, Michael, right?
That is correct, and that's on both the annual rental income and what might be more important is on the sale of the property.
Oh, on the sale of the property. A lot of people overlook that, and I see a lot of returns where the gain on the sale of a rental real estate property is subject to the 3.8% tax. And sometimes the accountant, not us, but some accountants will look at it, and when they do the tax return, it just may default to be subject to the tax. So anyway, going on, itemized deductions. There's careful planning there. The SALT limitation is subject to a $10,000 cap for real estate taxes and personal property taxes and real estate taxes. And we talked about the PTT. Net investment interest and other interest expense. I always tell people, if you have a home mortgage, the current home mortgage balance, if you get a new loan, it's the interest on $750,000. And previously it was $1 million. They got rid of the cap for the home equity line of credit amount. That's no longer deductible. But if you borrow, let's say your business is struggling, because a lot of businesses are struggling nowadays. And let's say a person with a house, he borrows $1.5 million. He refinances his home mortgage. He had a mortgage of $750,000 on his home mortgage. He refinances it and pulls $750,000 out and puts it into his business. You got to be careful, because maybe $750,000, the interest on the $750,000 is still deductible as home mortgage interest, but the other interest on the other $750,000, you may be able to classify it and deduct it against your operating business. Do you see people doing that, Michael? Or
absolutely, it's part of our planning toolkit. Doing with that, possibly, you can use your investment portfolio, buy a property, maybe for cash, and then taking a mortgage later on and put it back into the portfolio, your brokerage account, and treat it as possibly as investment interest expense to get a deduction there.
Yeah, there's a whole concept of tracing rules that Michael's outlining exactly. And just a word of caution is if you're going to take money, borrow money against personal assets, it would be best to give us a call, and we can help walk you through the planning aspects to ensure maximum tax deductions for your interest. Because if you borrow against your house and use it for personal purposes, the interest on the first $750 is a deductible. So you got to be careful on that. Okay. The other thing is this excess business loss. This thing, it really catches people by surprise. 18, 19, and 20, because of the CARES Act and the pandemic, they eliminated it for those 3 years. But for 21, 22, 23, the concept is this. If you have business losses in excess of $500,000, and that's indexed by inflation, if you have business losses in excess of business income, you can only offset your other income by up to $500,000. It's indexed for inflation, so I think it's $542,000 this year. So you can offset that. So think about an investor with $1 million of long-term capital gains or short-term capital gains on stock sales, okay? And if they have wages of, let's say, $100,000, okay? So that's maybe $700,000 of income. If they have business losses that they're able to deduct from their business, they're only able to deduct $524,000 of it. The excess gets carried over. So there'll be a surprise. And there was a little tweak what they did. Originally, when this rule came into effect, wages was included as business income. They changed it. And they said wages is no longer considered business income. So that cap is going to cost people more money. And it also affects people with New York State adjustments and so forth. So that's kind of important. I'm going to just jump to NOLs for a second. Net operating losses. People are very surprised because when you think of you think of a business, you have a net operating losses, it creates opportunities. And in 18, 19, and 20, you were able to carry those losses back. In 21, 22, 23, net operating losses, meaning your business expenses exceed your business income, can only go forward, carry forward for 20 years, but you got to be sure of a profit. So what you want to do is, if you are in a loss situation, you got to plan on the best use of your NOLs or net operating losses. Michael, give me some ideas of what you're talking with clients about how to best use your net operating losses.
Well, there's a couple of things. One is you want to use it against ordinary income or short-term capital gains,
Right,
as opposed to
exactly.
long-term capital gains because of the rate differential. That's one thing. You also have to be careful. Although there's an unlimited carry forward, and people might have, because of the pandemic, we're seeing a lot of big losses, and people may have income this year, and they think they're going to be able to offset all their income and not have to pay any tax. But one thing about the NOLs, they're limited to 80% of
Right.
the income. So taxpayers have to be aware that they will likely be paying some tax. Obviously not as much as if they didn't have the NOLs, but they still will be paying some tax as they utilize those NOLs.
That's exactly right. Next slide, please. That's a great point. Okay, so if you have an individual and you have a business owner, the one thing you can't overlook is if you're over 70, 72 or over, you have to take out your required minimum distribution. There's some exceptions to it. If you require minimum distributions, $100,000, you can take that money and move it to a charity, and you don't have to report the income, nor do you get the charitable donation. But it's satisfying your required minimum distribution without paying taxes on it. The other thing is if you don't have if your business doesn't have a deferred pension plan or some form of a pension plan, this is a beautiful thing. The defined benefit contributions for this year is the maximum is $61,000. If you're over 50, there's a catch up of $6,500. So you can put away a decent amount of money. And again, we're talking about deferring income. So if you can take $61,000 or $67,500 if you're over 50 and put into a retirement plan and let it earn tax-free money or tax-deferred money until a later point in time. That's all great. Again, there's other limits for IRAs of $6,000. You get another $1,000 for that, and those are for people who are not active in other pension plans, and so forth. So these are some deferral techniques that you can do. And if you have a small business and you actually get a credit for installing a pension plan for the first time. So there's a little bit of an incentive for the business owners to do that. I don't see, so I'm a big fan of putting money away for your own retirement. It's a good thing and it's a powerful tool and you really get a good benefit. Michael, what other things do you think about on pension plans?
Well, I think for our clients and other taxpayers that might be young and have a long horizon before retirement, we're all familiar with Roth plans. If you could put money into a Roth because maybe your income today is not up to the maximum to be taxed at the highest rates. So you put it into the Roth and then your income will never be taxed. So it's not it's not a deferral on that part. You're paying tax on the initial contribution, but when you withdraw it, there's no taxation. And if you're early on, children of our clients who are just starting out, it's a great thing because they have many years to grow it and never pay tax on it.
That's right. And that's really terrific. And that's a great idea. Now, on the next slide is, Michael will take it, but one of the things I want to mention is when we talk about utilizing the tax rates to your benefit, if you're in the highest tax bracket and you have a family members and you have young kids, or you have maybe kids in college or younger people and younger family members in the business, what you want to do is, to the extent that tax brackets, the younger children are in lower brackets, what you could do is do a gifting program and transfer assets that are generating income to the younger family members to utilize the lower tax brackets. So gifting planning and lifetime planning saves income taxes as well as future estate taxes. So, Michael, why don't you just go over some of these things that we talk about with estate planning?
No, but Barry, you're 100% correct. We think of the gifting as really an estate and gift planning mechanism, but it also can be a way to best utilize within a family unit all the different brackets and not let them go to waste.
That's right.
So, as we know, we have an annual gift exclusion, and then we also have lifetime gift and exemptions. Now, these are all indexed for inflation. The annual gift tax exclusion goes up each time it passes $1,000. So in 2022, we're able to give away $16,000. In 2023, we can give away $17,000, and that's from each person to each person. So for husband and wife to one of their children, you could give away in 2022 $32,000, and in 2023 $34,000. So it gets a little bit away, and if you have multiple kids, you could give away to each of them. You could also, if you don't want your kids, maybe they're young and you don't want them to have access, you could do it into a trust for them, so you can keep control to some extent of that, of the disposition of those funds. As you can see, the lifetime exemption, and we've heard a lot about it. It had been at $5 million. And then under, the TCJA, it went up to $10 million, but it's indexed for inflation. And obviously you can see the increase in 2022 where it was $12 million. It's going up to almost $13 million in 2023 because of inflation. So people who have utilized and planned and used their lifetime exemption up, you now have an additional $1 million or so, just under $1 million of exemption to utilize. And you could do some nice planning with that, especially at a time when, maybe stocks and assets are at a lower value because of the markets and the volatility there. So it's a good thing to take advantage of during your lifetime, as opposed to waiting until death. There's also, as part of this, and I put on the chart on the bottom, given what's going to happen to these exemptions, this lifetime exemption, and also the annual exclusion over the next 3 years. So given an 8% inflation rate, if it stayed steady at 8%, you could see the numbers. And in 2026, because there's a sunset provision, in 2026, it drops down to the $5 million. But because of inflation, it'll drop down to $8 million. So you're going to lose basically $7 million of lifetime exemption if you don't use it before the end of 2025. Unless obviously Congress does something and extends it, which is always a possibility.
That's right.
Barry, is there any other planning? I know there are a lot of other mechanisms. One of the things I've been thinking about with my clients, because a lot of them are nervous, have recently got nervous because of the market volatility of having enough to live on. Are there things that you've seen them combine to really give them some comfort with that?
It's funny now that there's a few things happening right now. The interest rate environment is increasing, and the applicable federal rates increasing. So when the interest rates were very, very low, these gifting of personal residence to qualified personal residence trusts are more attractive now with higher interest rates. So giving away the house, your personal residence or vacation home, seems to make a lot more sense now than it was a couple of years ago. Giving away, so if you own a building or you own a partnership interest generating profits and using that money to live on it, what I'm seeing people doing is carving up that partnership interest and gifting that partnership interest to a trust or grantor trust of some sort. So some of the cash flow can be, you can retain some of the cash flow and you could be the gifting. Now, real estate still, valuations, I still think are really lower than in commercial real estate. Well, I think it's a great investment, and that's my personal opinion. I still think that rental real estate is being depressed a little bit more, some markets more so than others. So if you own some of that real estate that's still generating profits, to the extent that you can do a gifting program to the younger generation, you're saving estate taxes, maybe income taxes, and eventually that growth, when it recovers and even grows a little bit better, you're going to be able to pass it on to the younger generation, gift tax free.
That's exactly right. And there are a lot of different planning ideas here, and I know Barry would be happy to, and I would be happy to speak to anyone who has any questions on it. We have about 5 minutes left. I think, let's go to the next slide, Heather. One of the biggest things has been residency planning. that I'm seeing our clients look at. People are don't want to pay high taxes anywhere and anymore, and if they can avoid it, they're looking to do so. And New York, as many states, have set rules, but New York is very aggressive, so you got to be careful and you got to really plan for it, because you want to make sure that you do it right. You don't want to go someplace, claim you're not a resident, and then have interest and penalties, because they can add up very quickly. So to give a kind of a quick overview, there are two types of residency. The first thing is your domicile, and that's where you truly really intend to return to if you go away. It's your true home. It's where your near and dear things are. You only can have one of them. So if you go on a long vacation, where you intend to, where your family are, where your business is, where you keep your collectibles or your jewelry or things that are near and dear to you. One of the things that in changing domicile you have to consider is, if you're going to leave one place, you have to land someplace else and set up another domicile. So we have a lot of clients who are leaving New York and going down to Florida, but they got to make sure they land in Florida. A lot of people confuse statutory residency and say, okay, I'm only there. I'm not in New York more than 183 days, so I'm domiciled elsewhere. That's not necessarily true. It's more than just changing a driver's license or registering to vote. You really have to have your near and dear things, your family, and other items that show that that's your primary home and someplace you return to. If you buy a new place down in Florida and you keep a place in New York, the one in Florida should be bigger, probably more valuable, although because of jurisdictional or geographical differences, from a monetary standpoint, it may not be more expensive, although Florida has gotten tremendously expensive over the last couple of years. But from a square footage, it should be at least as big, if not bigger. Then once you have changed your domicile, you have to look at statutory residency. And this is the one most people are familiar with, where you have to, can't be in New York or in the state greater than 183 days, and also have a permanent place of abode for basically the entire year. New York used to have a rule that substantially all of the taxable year was more than 11 months. They have changed that to be more than 10 months. So if you're renting an apartment here and you think you can leave November 15th, before you wouldn't be considered statutory residency. Now with this new rule, you will be. For that, you have to maintain a diary. You have to prove that you're out of New York 183 days. One of the things that's really important is knowing that being in New York for a minute, an hour, other than passing through, counts as a day in New York, and people don't realize that. Barry, is there anything, because we're running out of time, is there anything else that you wanted to add to the residency planning that you're talking about with your clients?
You know, it's funny. I always say that, okay, so let's say a New Yorker is looking to move to Florida, okay? The tax incentive is the New York tax rates maybe 7 to 10%. New York City, with New York City could be 10 or maybe even higher depending on your income in New York. If you move to Florida, the tax rates in Florida is well known to be zero. So there's an incentive. So, but the problem is I call it the transitional time. So you don't just pick up and move and sell your house in New York and go down to Florida and buy a new house. And it's always not a clean cutoff like that. So when you look at these two definitions, domicile and statutory residency, there's unclarity in it, okay? And what I mean by that is if you make your true home Florida and you still spend time in New York, you could be a dual resident and people don't realize it. And if you have a dual residency of Florida and New York, that's not so bad because you're only paying taxes in one state. But if you move from New York to, let's say, New Jersey, right? Or New York to Hawaii, or New York to California, you're not moving for tax rates, you may be moving for other parts. So you may end up being a domicile and a statutory resident in two states. And in that case, you get taxed on double income on your investment income. So you got to be really, really careful. And the planning is very, very difficult, as Michael mentioned, on doing these type of things. So, and this is both for income tax planning and estate planning. These rules are not independent of each other, though people look at it differently because they're looking long term. So these are some of the technical rules that you want to look at and be careful with. That's just my thinking, Michael.
Yeah, I think it's great because it is a great point, Barry, of, being a dual resident. And the one thing is we're used to having income in from another state, from a non-resident state, we get a credit for the taxes we paid there. If you're a dual resident, you won't get that credit. So this really takes a lot of planning. And some states, like New York, are very aggressive. And they're going to look to various documentation, especially with regards to statutory residency. They'll subpoena, if they have to, phone records. The cell phones now tell you exactly where you are. Easy Pass, your receipts. They'll also credit card receipts. So there are a number of, I guess, tools in the governmental jurisdictions toolbox to use to try and thwart this claim of residency or change of residency.
Mm-hmm.
And I think with proper planning, it certainly can be done if the facts allow for it. But it's something that you really have to consider, and just don't take it lightly and say, okay, they can't track me or they won't look at it.
Mm-hmm. Mm-hmm.
I know we had 2 more sections to do, but I believe we're out of time. I think in a further webinar, the 2 topics of the qualified small business stock and qualified opportunity zones are worthwhile 2 worthwhile topics to think about. If anyone wants to talk about them before we're able to put together the webinar, feel free to give Barry or myself a call.
Thank you. Yeah, absolutely, Michael. And basically these concepts is you have gains, whether it be short-term or long-term gains, and you meet certain criteria, you're able to defer the taxes on that gain to a later point in time, or possibly even eliminate it to its entirety. So to the extent that you can take advantage of this 1202 or the 1400Z, there's a lot of good benefits for it. And I think there's a lot of good things to come over. If you're facing some gains and you were looking to defer some taxes, give us a call. We're happy to assist.
Thank you, everyone.